Hello, everyone. Welcome to the final bar. Today, we'll talk about the market continuing to push to the upside, making new all-time highs. To wrap this week, we will do our weekly wrap session today where we focus on how the markets have evolved from last Friday to this Friday. If there's anything different today, it's the improvement in the cyclicals, things like materials, financials, especially up over 2%, as rates stop going down, start bouncing up to the upside. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the markets using charts. I've had lots of discussion with lots of people over the years about all the different inputs we can use, particularly yesterday with Mark Chaikin, a great discussion, brief discussion about just combining fundamental and technical analysis in a meaningful way. But I always come back to the basic concepts of trend and momentum. If you know nothing else about a stock, nothing else about a particular ETF or a ticker, start with the chart. That will tell you a lot about what you need to know about the conditions around that particular issue. All the other stuff will help you validate that and understand it a little better, but make sure that the chart is part of your thought process. And hopefully by the fact that you're watching the show, you've come to the realization of that for sure. Excited today, by the way. Friday is a fun day for two things. We get to wrap the week, look at the long-term evolution of these markets, but also answering some of your questions from the final bar mailbag. We have a couple good ones to share with you today. Great guests this week. Had a lot of fun talking with guys like Andrew Thrasher, Sam Stovall, Mark Chaikin. These are three solid guests. Next week, more fantastic guest appearances to share with you. On Tuesday, we have Gary Dean from sentimenttiming.com. On Wednesday, the 11th, Samantha LeDuc from LeDuc Trading joining us again. On Thursday, the 12th, Matt Tuttle. Matt is the founder of Tuttle Capital Management. They're the creator of ETFs like SPCX, the first actively managed SPAC ETF. Should be a lot of fun picking his brain on what he's seeing given this environment that we're in. We're going to get to our weekly wrap segment here momentarily, but first I want to start with our poll. We always have a poll running on our StockCharts TV live stream page right off of StockCharts.com, but also on social media. We send polls around regularly, and this week we asked, will the next 10% move in the S&P 500 be higher or lower? Let's keep it super simple. You have two choices. Where did we net out? 6 to 4, 60% to 40%, opting for lower over higher. I did not vote in this poll. If I did, I would have agreed with the majority in this case and agree that the next 10% move is going to be lower. That's a tough one, though. And it's hard to be, suggesting a 10% drop, given, number one, that we haven't had one year to date. Maybe that's what makes it easier, I guess. But other times when it felt like we were certainly at the precipice of a 10% move, we never got anywhere near that. Most we've had is 5 to 6% at the most. And we continue to go higher, right? Again, we have another week of making higher highs. It's interesting as we go into our wrap the week segment a little more deeply. I'm struck today. My conversation with Mark Chaikin yesterday was very constructive. He was super constructive on the market. He suggested a seasonal pullback made a ton of sense, which most of my guests did. And Wednesday with Sam Stovall was a really good discussion about August and how challenging that tends to be for stocks. But still, there are plenty of Augusts that turn out just fine, right? Remember, these are seasonal tendencies we're talking about, not seasonal facts about what August is going to look like. I'm interested recently today, I spent a lot of time earlier in my career working with Tom DeMark and people that use DeMark indicators, which actually just registered a major sell signal today, if I remember right, on how the count was going to play out. And that's based on basically the daily close versus the high and the low. There's a lot of details behind his indicator, but basically it's a measure of trend exhaustion and just triggered a sell signal today. So for what it's worth, we certainly have had negative breadth conditions. We now have some seasonal trends that are suggesting negativity. I think the Tom DeMark signal that we may be rolling over as well is setting up for next week to be potentially painful, but As long as the S&P keeps making higher highs, there's not much pain to be held unless you're short or in cash. And the S&P just closed, touched 44.40 earlier today, closed around 44.36. Now, there wasn't a huge up day relative to previous ones. And yesterday, you had a huge acceleration to the upside going into the close. Really didn't see that today. It was more, range bound for the course of the day. Noticeably, the NASDAQ and the NASDAQ 100 both down today, 4.4 to 0.5%. Technology was one of the weaker parts of the market. Consumer discretionary was the weakest of the 11 sectors. And the VIX actually went back down. It's teasing 16 from above. Real story today, and we're going to hit just a quick recap before we get to the weekly trends and and how things have evolved. But 10-year yields testing 130 again. Now, these were in 111 a couple days ago. So it's been a big bounce in rates, and that's why financial stocks are doing just fine today for sure. Higher rates tend to be better for cyclicals, particularly financials. That really speaks to their business model. So bond prices, the TLT that we usually follow, down almost 2% today. The dollar index appreciating back up to 25, sort of a larger move than we usually see for the dollar, but still remaining below 25, which has been a ceiling of sorts in recent weeks and months. Gold really accelerating to the downside. Precious metals both feeling a good deal of pain today and selling off going into the close with the GLD below 165 here. Most of energy was, most of the commodity complex was down today. Energy actually was up 1% looking at the energy sector. A lot of discussion about cryptocurrencies today, and Bitcoin up 5% today to finish the week relatively strong, touching the 43,000 level. And we talked about 42,000 being a key resistance level. We traded just above that in the last 24 hours. So I think going into the weekend, which tends to be a little lighter trading as you would expect, but going into the weekend, into next week, I think we're very keen to see if 42,000 holds. I think that is the first level. That's the resistance level that's been proven a number of times in recent months. I think eclipsing that, and today is not enough to say that that level is broken. That's trading above it. Closing above it is one good thing. Remaining above there is going to be key. So we'll see how things play out through the weekend into next week. Let's look at our weekly wrap chart, or wrap the week chart, if you will. So these are color coded. I'll explain to you where we're at. The S&P 500 is here in black, which finished the week about 0.9% positive. So sort of a, not a huge follow through week, really signaling broad strength. Breadth overall readings are relatively weak relative to where they have certainly been in previous bull market cycles. And while this is not an accelerating market, it certainly still is an improving market. And as I've told people earlier, I was writing a note to my own subscribers earlier today, and I'm not struggling to find stocks making new swing highs today. For example, we have the broker dealer index making a new all-time high. So there's no shortage of stocks like Morgan Stanley in that sector or elsewhere in healthcare and tech and in many other sectors breaking to new highs. It's happening, but I'm also not struggling to find stocks that are breaking down and are feeling some pain on the downside, following through to the downside. So it's sort of a disagreeing market, if that makes sense. So what outperformed the S&P this week? Not much. Here in pink, we have the NASDAQ 100, which was literally just a rounding error, about 1%, we'll call it. For the week, 1.1% are small caps, which is up here at the top. It's not been often that the small cap index has outperformed the S&P, and that just came really on the strength today with financials and some of the cyclicals working. Everything else pretty much underperformed stocks this week, with emerging markets and the dollar both up about 0.6 to 0.7%. Down for the week, we had bond prices down 1% using the TLT, gold using the GLD down 3.1%, and the worst of the bunch, crude oil down 6.1%. This is using the USO, which is a good kind of short-term gauge. I'll use that for intraday movements. But anything longer than a week, I'd encourage you to use the crude oil future. That's a better measure. That's $WTIC on StockCharts.com. Let's add Bitcoin in the mix just so we can see where that was. And it was actually the worst going through yesterday, and then, through earlier in the week, and then just accelerated to the upside. You can see it pushing higher and actually winning the week here relative to the other asset classes, finishing up 1.5%. Most of that, if not all that, came today, really, with a big move to the upside and finishing strong. The last couple of days have certainly been pretty good for Bitcoin. It's an interesting chart because it's been so range bound between 30,000 and 42,000. We're testing the upper boundary of that, and I think that's a really key chart to watch. It's interesting to see how it trades over the weekend, because last weekend was a little more movement than normal. So let's pay attention to that for sure. Let's finish up the wrap of the week segment here, looking at the Mindful Investor Live chart list. If you're new to our show or new to my work, you can access this list from StockCharts.com at any point. Go to the member dashboard, click on articles. Actually, is the easier way to do that. It's at the top of the website. Up here where it says Stock Charts blog, go to my homepage, which is called the Mindful Investor, and you'll see a little button at the top that says Live Chart List, and we'll get you to this list of charts, which we'll review now together. We start off with the market trend model. We review this every Friday at the close, and that's when I update it. I try not to touch it or mess with it intra-week, but I focus and update all the readings as of Friday. No change in this model really for the last couple months, to be honest with you. The long-term model has been bullish since June of 2020. The short-term model has been bullish except for about 3 or 4 weeks over the last 8 months where it's flipped negative. But overall, the short-term trend has remained positive, and that makes sense given the trajectory that we've had. The medium-term model, though, turned negative for me in May. And the way I think about that, that's sort of my main risk-on or risk-off model. What I tend to think of it this: should I be leaning more thinking about return or thinking about risk, or potential return versus potential risk? And the sell signal that you got in May tells me to think more about potential downside. And it's been very helpful in terms of recognizing the weakness on charts like JP Morgan and others making lower highs, energy, a lot of the cyclicals that have rotated lower, airlines and others that, started to show signs of strength and all started to rotate lower. It's been great, very, very good for managing the downside risk there. The challenge, though, is obviously the market has continued to go higher, and I've described this market as what I call a stealth correction, where the indexes are going higher, but there are a lot of stocks that are not participating in that. So if your portfolio is comprised of the wrong names here, you probably have had a painful couple months as the S&Ps and NASDAQ has gone higher, but the stocks you're holding, particularly if it's leaning into the cyclicals, are struggling a great deal. Really, really close the last couple of weeks to turning positive. It has not turned positive yet, and I try not to overthink this model. This is just the thing that runs in the background. If it would turn bullish, then that tells me to be much less cautious and be thinking about upside potential. But the fact this remains bearish during a seasonally very weak part of the year, given the exhaustion indications I mentioned earlier and the breadth deterioration, I think it's overall, I'm leaning more negative than positive, which is tough when the S&P 500 chart looks like this. Now, I have to tell you, remember, I'm a big believer in trend following. I'm a big believer that there are 3 things you're trying to do. Number 1, identify trends. Number 2, follow those trends. And number 3, anticipate when those trends are over. So in terms of identifying trends, it is undeniable that the trend in stocks has been higher. And I would say based on the performance of the S&P around its 50-day moving average, until we violate that, even given a short-term pullback, I will remain pretty constructive overall in the market as a whole, because the 50-day has been support. That has been the level. At some point, the 50-day will not hold. If there's one thing I can guarantee, it is that we will not remain above the 50-day moving average forever. At some point, we have to break it. I'm amazed we have not broken it yet. I certainly have expected it before now. I will believe it when I see it, which means until then, you have to assume that the 50-day moving average continues to indicate the strength in stocks. So following the trends, I've had no problem following the trends that we've mentioned, stocks breaking to new highs, stocks remaining in strong price and relative profiles, I think are good. The market itself, I think, still deserves the thumbs up vote as it continues to push to new highs. In terms of that third piece, which is anticipating when the trend may be exhausted, that's where the breadth deterioration comes into play. That's where the bearish momentum divergence, like we saw in July, comes into play. Overall, again, the trend is the trend, and previous momentum divergences, like we're seeing now, have led to a 4 to 5% pullback in the S&P. I think that's a reasonable expectation here. If you ask me to predict what is going to happen, and again, I don't know any more than anyone else does, but I think a base case, given the seasonal weakness, given the breadth deterioration, given everything that I mentioned, is the S&P goes down about 10%. That would take us to 40-50. That would shake out a lot of the overextended nature on a lot of the charts that I've seen. That will shake a lot of people out that have just been buying and enjoying this uptrend. I think from there, though, you can set the stage to accelerate and make new highs for the end of the year. That would be my base case. However, that is a total guess. I actually I put a video on my YouTube channel a couple weeks ago talking about what a correction could look like, and gave 4 different scenarios of what the market may do. And another one called a Choose Your Own Adventure. You actually vote on which of the scenarios you think makes more sense. Check out my YouTube channel called Market Misbehavior. If you want to see those scenarios, I'll talk about the one that I just mentioned among many, many others and what they might look like as they play out. In terms of market breadth, when I talk about breadth deterioration, two charts come to mind. This is one of them. This is the advanced decline line for the S&P 500, making higher highs and higher lows as the S&P makes new all-time highs. These are all the other advanced decline lines making lower highs. So the most recent up move, June into July, was not confirmed by any of these other breadth measures. That is pretty much what February of 2020 looked like. Now, the only difference we've had from now and then, from a technical perspective, is that the index is not broken down yet. That's what happened there. By now, in February 2020, you've rolled down to the downside. So again, I feel, as I have a number of times, we're setting up for a downturn. I've not seen the downturn yet, and again, I'm going to respect the trend. Continue to be happily holding names that are making higher highs and higher lows. In terms of new lows, you have a number. It's not many though. So if you look on the S&P 500, this week on average, you had about 50 to 70 names. That's about, what do you call that? 10 to 15% of the S&P making new 52-week highs on the average day, and only 3 stocks making a new 52-week low. That is very, very, very small. You still have a small handful of numbers on the New York Stock Exchange. Look at the new highs, new lows on the NASDAQ, by the way, which I'm not showing here. And you'll see that there are plenty of new lows. And there's a lot of stuff in the NASDAQ that is questionable, much more than in the S&P or on the NYSE, but worth noting that some of the higher beta, riskier stuff has certainly broken down. Last chart or two, and then we have to wrap it up here. Only 57% of the S&P members above their 50-day moving average. We'll see when that updates for Friday's close today, where that registers maybe above 60. I think that would be an interesting change, because the lack of stocks breaking back above their 50-day moving average has been an important piece. That it would have to be the cyclicals that would cause that to happen most likely. The bullish percent index, by the way, still remaining below 70, but really close to giving an all clear and getting back above that bullish line. That is what I will absolutely be looking for next week to see if that actually happens. Let's take a quick break. We'll be back answering your questions from the Final Bar Mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we focus on the market trends and how they're evolving together. A couple quick announcements before we get to our Final Bar mailbag. Our mailbag segments are always driven 100% by your questions. We'd love to hear from you. And again, we've appreciated so much some really thoughtful, well-described questions that you've been sending to us since we started the show a couple years ago. We'd love to keep that coming. Send us questions that come up as you're analyzing your own charts, questions on particular technical indicators, on market dynamics, market history. We're going to do our best to point you in the right direction. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube on our Stock Charts channel. Put a comment below the video that you're watching there. We would love to hear from you. Hope to answer one of your questions in our next mailbag segment, which will be Tuesday of next week. Also, go to StockChartsTV.com. We have an on-demand platform that is beautifully designed by the StockCharts TV team, and it features some of the fantastic content on this show and many others. We have a great amount of content we put out every single trading day, featuring really thoughtful hosts, some wonderful guests like Mark Chaikin, Sam Stovall, Andrew Thrasher, and others. Special events like Charting the Second Half and The Pitch. Go to StockChartsTV.com. or look on the App Store on your mobile device and just search for Stock Charts TV on demand. Let's continue on here with our mailbag segment. Again, these are all driven off of your questions that you send into us. We are here at all times. The Final Bar at StockCharts.com is our email. Let's get to it. Question number 1, why is this the weakest part of the year, May through October? Thanks always for your knowledge-filled analysis. I appreciate that feedback. Why is this? It's a really good question, and just talking with a couple of my guests this week. You have Mark Chaikin yesterday talking about the seasonal trends. Sam Stovall in particular on Wednesday. We talked about the weaker August and what it is. There are a number of things. Call it the summer doldrums. In general, this tends to be lighter volume. A lot of people taking vacations, and again, this is all anecdotal evidence that I'm throwing at you. Sort of mid-year, this is sort of the time when, in general, things are quiet. The entire continent of Europe seems to be on vacation for much of the month, and so as a result, things are a little lighter. And so there's not a lot, of upside momentum for things. It sort of dissipates right about here. If you look at a lot of the major corrections that we've had going back in market history. A lot of times it happens third into the fourth quarter, sort of September into October. A lot of the major pullbacks have happened in that time. There's an interesting phenomenon, with seasonal tendencies. There are some anecdotal reasons why that could be the case, and particularly in terms of why the seasonal trends tend to end, right? Think about August into September. September 30th is the end of the third quarter. So a lot of times that'll be a time when money managers will be thinking a lot about performance and thinking about cleaning up their portfolio and things that have been, losses that they need to sort of wrap up and sort of get things squared away. What happened at the end of the third quarter, and that sets the fourth quarter up to be a time when you can put aggressive bets back on and push hard to the end of the year to improve your performance. If you could. So there are legitimate reasons like the seasonal, the seasonal patterns in industries and sectors, things like when products are being sold. A lot of that, I would argue, is sort of priced into the market already, and that's priced into the expectations for things like consumer goods. I think a lot of it, to be honest with you, as a pure technician, I think of it as just one of the realities of market history. Certain things like the Santa Claus rally, the small cap effect, the January effect makes sense because that's when money managers and investors will be taking certain actions for tax reasons, for window dressing their portfolios. Other things, it's just the historical tendencies of the markets, and if nothing else, the trends tell you where things have tended to play out. And to be honest with you, that is my short answer to that question. A lot of people like Yale Hirsch and his son Jeff Hirsch, who run Stock Traders Almanac now, can tell you a lot more about the details as to how those seasonal trends have played out. Next question: when you're looking for charts for potential breakouts, you have indicators that inform you of which stocks will be potentially larger or longer breakouts than others. Which indicators, and what order would you put them? Yeah, I'm always finding leaders too late. Really good question. That's a very, very thoughtful question, actually. I was actually talking with Grayson Rose this week. We're talking about this exact topic. He actually did a really good video recently talking about trailing stops. And one of the things we talk about, and I'm using an example of Morgan Stanley, just thinking of a stock that's breaking to new highs where the relative strength is making new highs. And, things that he and I talked about were, finding good ideas. It's all about bases and it's all about stocks breaking out, right? Stocks that have hit a level at which you might expect resistance, but they've broken above that level. And in terms of differentiating, there are things that you could do in terms of looking at the characteristics of the trend, right? Is the stock overbought as it reaches resistance? Are you seeing big gaps as it breaks above resistance, which might be an exhaustion gap, which would tell you, it's more consistent with the end of a move. For me, though, what Grace and I talk about is it's less about that. It's less about predicting ahead of time, and it's more about money management, right? For me, the successful investors I've worked with are not the ones that can magically predict the best ones to buy out of all of them. They would be more likely to buy all of them and then just manage the trades more effectively. So if you have 10 stocks that are all making new highs and look kind of like Morgan Stanley, you go into all of them, and then some of them are going to continue to work, and you let those run, and some of them are not going to work, and you take those off the table, and you have names that you can swap into, and it's more about managing your potential downside and more about guessing which ones correctly are going to do better going to the upside. I think money management has a big part of the technical toolkit for me. I would argue some of the best benefits of charts are managing the downside potential. So what can you do for that? Well, if you watch his video on trailing stops, you'll see things like the parabolic systems, which Wells Wilder designed in the 70s. I don't know if you mentioned the chandelier exit, but that's an Alexander Elder design, if I remember right. It's based on average true range, which is a common way of sort of sticking with it. Even just looking at the 50-day moving average and sticking with something as long as it holds above its ascending 50-day moving average, looking to see if the relative strength remains strong. There are a combination of things like that that will tell you, make sure you stick with what's working and get away from what's not working. It's funny, we're doing a paper portfolio competition with my StockCharts TV team, which are graphic designers and producers. I will tell you right off, I am not at the top of the list. I'm struggling a little bit relative to my teammates. But I would tell you, we talked about it as a team yesterday, going through some of our portfolios. And, I mentioned to one of them that if you have a group of stock, you have your portfolio, some of them are working and some of them are not. What we love to do is sell the winners and lock in the gains and keep holding the losers and hope they'll go higher. And unfortunately, what happens if you do that enough is you have a portfolio of underperformers because you keep weeding out the top performers. You want to do the opposite, stick with the winners and get rid of the things that are not performing as you'd expect. Maybe the last question here, because we're almost out of time, but sorry, I wanted to get to some of that. Two questions on Andrew Thrasher's presentation yesterday. I really like the answer that he gave. Let's see about, how would you know if the bullish trend is changing? He said that if the S&P broke its 20-day moving average, and if greater than 5% of stocks were making the 6-month lows, that would be a sell trigger. Can we screen for, or can we chart the percent of stocks in an index at 6-month lows? Great question. No, we can't yet. That's on my list, on my chief market strategist hat. I'd love to improve some of our breadth data. We have a lot of really fantastic breadth data. It's incomplete and it's kind of spread around a lot of places. I learned where the breadth data was on StockCharts by asking guys like Tom Boley and Arthur Hill and Greg Schnell and John Murphy and Chip Anderson and Grayson Rose. Where do I find this kind of thing? And I should also mention Carl Swanlin, who has done a ton of really cool breadth indicators that we have on our platform. But on top of that, I feel like we could organize them a little better, and I'd love to look at things like that. And I made a note when Andrew mentioned that as well, that I'd love to do some of those additional timeframes. So other timeframes, things like that, particularly breadth indicators that you would love to see us have, shoot me an email, thefinalbar@stockcharts.com. I'd love to hear it. I'll be working on that at some point, hopefully sooner rather than later, and I'll make sure that we include everything we need to. Oh, that's it. Boy, the mailbag segment goes so quickly, but I've been trying to do a couple less questions and answering them more thoroughly, and I hope you find that helpful. I appreciate so much your questions. We didn't get to some of those, and I'll make sure we get to them at the beginning of next week. We need to wrap the show, though, and wrap this week. Go to the 3 and 3. 3 charts in 3 minutes. Here we go. Chart number 1 is Square. We had a lot of earnings this week. I feel like we touched on them a little bit. We didn't get to go through all of the charts that are reporting. I'd encourage you to check out things like DraftKings, AMC, Norwegian Cruise Lines, all reported today before the open, and plenty earlier today, including Virgin Galactic, which is an interesting one. Also reporting yesterday was Square, SQ. And I'm looking at this chart. This is one of those charts that I really want to like because it's very, very close to breaking to new highs. We had the resistance in February, resistance in April. We were right back there. And when I moderated the pitch last week, if I remember right, we had 3 different strategists, all 3 of them keyed in on the same space. We had MasterCard, Square, and PayPal all pitched to us by one of them. Each one of them had picked that same group, different stocks, but in the same group. And I was really thought that was a very compelling takeaway from that episode. And Square is really, really close to breaking up, but not quite doing it. Down today after earnings yesterday, but I'd be looking at this next week to see whether that's able to move on to new highs. Relative strength has certainly been encouraging. That chart, but sort of already breaking out, is the chart of the XBD, the broker dealer index, which is a $XBD actually. Financials have been a group that has just been fine to ignore for a while. The XLF overall has been relatively stagnant, but you have had pockets of strong performance. I showed Morgan Stanley earlier. We've talked about the specialty finance group, Moody's, and others that have had pretty good runs so far, while the sector as a whole has been struggling. And while stocks like JP Morgan, I would argue, still have a lot to prove to follow through to the upside and indicate that they're not going to break down through clear support levels, the broker-dealer index and other things like this breaking out to new highs certainly puts a check in the plus column. Now, this is driven this week, I would say, by a rising rate sort of situation, bouncing off of the lows there on the 10-year, getting up to 130. That's a key theme to watch going into next week. Also, not just for the strength for financials, but potential headwind for technology. Finally, we have the chart of gold. Gold has been relatively sideways, and I've talked about the long-term strength and the potential to rotate higher. I love this higher low in June after the low in March. We're right back down to that level, though, with the gap down today and gold down, 2.5%. Going into next week, I think this is a really key chart to see if it's able to hold this level. It's where we had that bullish divergence back here at the end of June. Is it able to hold that level around 164 and rotate back to the upside? If not, I'd be looking back to those March lows as our next support level. Folks, that is our show for today and a wrap for this week on the Final Bar. I want to thank you so much for joining us every weekday after the close for our show. Keep your questions coming. You can get them to us via email, thefinalbar@stockcharts.com. Also, go to stockchartstv.com and watch all of our previous episodes and great interviews on demand. For stockcharts.com, I'm Dave Keller. Be well, be safe. Have a great weekend, and we'll see you on Monday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.